Happy morning to all of you. Myself E. Kalichalivi, Assistant Professor, Wales Institute of Science, Technology and Advanced Studies. Now I am going to talk about Week 3, Lecture 5, Departmental Accounting. These are the content included in the Week 5. Week 3, Lecture 5. Interdepartmental transfer at selling price, meaning and sum. Meaning. Goods may be transferred from one department to another. Similarly, service of one department may be used by another department. In such cases, the transfer may be made at cost price or at usual selling price. When goods or services are transferred at a price above cost, the receiving department must be debited with the amount of transfer in the departmental trading account, and the transferring department must be credited in the departmental trading account with the same amount. In case of service rendered, no further adjustment is needed. If goods are transferred and all the goods transferred are sold, then also no adjustment is required. Sum number 1, that is the problem. Before starting the sum, I want to explain something. You should prepare trading and profit and loss account balance sheet, that is the common, because you know the value, you know the financial strength of the department. So that is the reason to make a trading and profit and loss account. A firm, that is, we go to the problem. A firm had two departments, cloth and ready-made garments. So cloth and ready-made garments, both the department in this problem included. The garments were made by the firm itself out of cloth supplied by the cloth department at its usual selling price. From the following figure, prepare department trading and profit and loss account for the year ended 31st 3/94. The stock in the ready-made garments department may be considered as consisting of 75% of cloth and 25% of other expenses. The cloth department earned gross profit at 15% in 1992 to 93. General expenses of the business as a whole came to 11 lakh, 1 lakh 10,000. These are the two department value are mentioned. One cloth department, another one is ready-made department. The opening stock on 1493 cloth department is 3 lakh, ready-made department 50,000. Purchase value also mentioned 20 lakh. Ready-made department is 15,000. Sales value of cloth department 22 lakh, ready-made department 4 lakh 50,000. Transfer to ready-made garments department is 3 lakh. Both the department transfer values 3 lakh, ready-made department no value. The expenses. In the expenses, manufacturing no value in cloth. In ready-made department 60,000. Selling value of cloth department 20,000, ready-made department is 6,000. Closing stock of cloth department and ready-made department. So 2 lakh is the stock cloth department, 60,000 is the closing stock of ready-made department. That is the working notes. In this working note, stock reserve also mentioned, as well as in ready-made and garments value, opening stock value, closing stock value also calculated. So let's move on to the working notes. Stock reserve has been calculated as follows. Rate of gross profit and sales of cloth department equal to 4 lakh divided by 25 lakh into 100. So gross profit of cloth department is 16%. Element of cloth in closing stock of ready-made garments equal to 60,000 into 75% equal to 45,000. Reserve required for unrealized profit in closing stock equal to 45,000 into 16% equal to 7,200. Reserve already existing in opening stock equal to 15,000 into 75% into 15% equal to 5,625. That is the already existing opening stock. That is the both the department trading account. So departmental trading account as on 31st 3/94. We know very well all the expenses, all the revenue included in the debit and credit side. After the difference in the, we find out the gross profit, brought down the PL and account. After PL and account, the net profit value we should calculate in the capital plus net profit we mention in the liability side of balance sheet. So to opening stock 3 lakh in cloth side, ready-made is 50,000. To purchase 20 lakh, ready-made 15,000. To transfer from cloth department no value in ready-made side is 3 lakh. To manufacturer expenses no value 60,000 is the ready-made department value. So in credit side the by sales value of cloth 22 lakh, ready-made side is 4 lakh 50,000. By transfer to ready-made department 3 lakh in cloth department in no value in ready-made department. By closing stock of cloth department 2 lakh, ready-made department 60,000. So overall total is 27 lakh in cloth department, 5 lakh 10,000 in ready-made department. The difference is 4 lakh is gross profit, 85,000 it is the ready-made department value of gross profit. That is the departmental profit and loss account as on 31st/3/94. Debit or credits are mentioned that to department also mentioned that cloth and ready-made. So in debit side to selling expenses 20,000, ready-made department 6,000. By gross profit brought down 4 lakh, ready-made department gross profit is 85,000. The overall total is 4 lakh, ready-made value of total 85,000. So the difference is 3 lakh 80,000, that is the net profit of cloth department. 85,000 is overall total. The difference value of 79,000, that is the net profit of ready-made department. So that is the general profit and loss account as on 31st/3/94. In general account, we should mention net profit, general expenses, stock reserve, stock closing and stock opening. Both the value are mentioned in the general profit and loss account. So first starting that to general expenses 1,10,000. To stock reserve closing values 60,000 into 75% into 16% is 7,200. In credit side net profit values 3,80,000 plus 79,000 equal to 4,59,000. Opening stock reserve of value is 5,625. 50,000 into 75% into 15% already in this working mentioned, already cleared. So closing opening stock reserve is 5,625. Both the side the total is 4,64,625 you mentioned. The difference value of 3,47,425, that is the net profit. In the net profit we should calculate of the balance sheet, capital plus net profit we mentioned in balance sheet. Thank you for listening.